I think your mic's muted.
There we go. How's it going, Joseph?
Good, how are you?
Good thing.
I didn't see the email till today about this, but I can fit it in, so it's perfect.
Yeah, good. I know I usually do them in person in the training room and on Zoom. Um, but I had a close conflict, so we won't go all the way up until 2. In fact, this will probably only take like 30 minutes to go through, and then you'll get a copy of the playbook.
Cool.
When did you join the brokerage?
About a little over 2 weeks ago.
Okay.
So pretty new. I
Congrats.
joined right after I got licensed, so
Awesome.
only been licensed since the end of April.
How's it going so far? Slow?
All right, yeah, it's just slow and then trying to figure out where I should dedicate my time most to and figuring out what lead sources are going to work best. So kind
Yeah,
of widespread right now, trying a little bit of everything until I figure out what's working and what I need to spend most of my time on.
that never stops.
Nope.
Just constant evolving.
Yeah, and
Um,
then I got the
where'd you come
tour
from?
stuff. Where did I come from?
Yeah, like what line of work?
So I'm 21, so I've only been out of high school like 3 years, but I went to college for a year. Then I became a golf professional up in Cleveland. I worked at a country club. And then I went back to school for a little bit, worked an marketing internship, and just didn't really. I like working for myself. And then I tried a little bit of business or entrepreneur. I mean, I've been in entrepreneurship for last year, and I got a business with my brother, remodeling, interior modeling. That
Okay.
I learned quite a bit about some houses during that, but partnership just wasn't going to work long term. So we just ended it, and I let because he was doing it before, so I just pretty much just backed out and let him keep rolling. And then didn't know where else to go, and somebody said, "Well, you could get your real estate license." And I was like, just thought about it, and I ended up here just
There
because
you go.
I don't necessarily want to do it as a career, but thought I could learn a lot, and it's not too expensive to get into it, and
Right.
even if I ended up just buying a couple houses for myself, I'd pay it off.
It's worth it.
Yeah.
Absolutely.
So I've kind of been all over the place. So,
Yeah.
but I'm here to learn. That's why
Well,
I'm,
and these mortgage hacks are a little bit more in depth than like if you were to join the productivity coaching, they do
that's
like
what I'm in right
yeah,
now.
they'll do like the high level loan products and basics, and then this is kind of like step 2 or level 2, like tips and tricks. Um,
Cool.
so
Yeah,
those
I've only
those
been in it for like 2 weeks, but we haven't really done a whole lot with mortgages. And I'll be honest, that's probably my knowledge is the lowest is in mortgage. So when I
it's
saw that, I was like, oh, perfect.
yeah, it's a whole world of its own for sure.
And I know we're not supposed to be experts in it, but man, it would definitely help when you're talking to somebody.
And it does. I mean, it
Thing.
works hand in hand to get offers accepted and get everybody to the finish line for sure.
Or even
And
just like talking to people and like, I heard these things are like assumable loans are popular right now with how the interest rates are. And I was like, I never even heard of that because they don't talk about that stuff in the course.
yeah, and those assumable loans, those pop up based on the market cycle. So
Mhm.
they're popular now because the rates are so high. But when the rates are low, nobody talks about them.
Nobody does them. Yeah.
So yeah, we'll touch on that too. Um, it's a little bit harder for first time home buyers to assume a loan because they have to come up with the difference basically. And a lot of people are not always able to come up with the cash on their first purchase. But
So is that how that works? Essentially, you just So you take over their mortgage, but where's the cash? You have to pay off what they owe, or how does that?
So you take over where they left off. They take
Yeah,
their name off the mortgage, you put your name on with the current rate and the current balance.
yeah,
But surely, like, the home's probably worth much more. They're probably going to sell it to you for much more.
yeah.
So then the buyer has to come up with the difference of what the house is sold for and what the balance of the loan is.
Oh, so depending on the situation, it could be huge.
Yeah.
Yeah. Okay.
Yeah. And you can't really get, like, a home equity line would be the natural go-to for that. But if you don't own the property, you
Mm,
can't use the equity in the property. So it'd be a second mortgage for a lower amount.
yeah, that's it's a little weird.
Mm-hmm. Yeah. In my mind, I'm thinking if you had, like a 25-year-old that has parents that want to gift them a bunch of cash to get them into their first home, and they could find an assumable mortgage with a low rate, I think that would be an ideal situation because they can just take over. Now they do have to apply for the loan and they have to meet the qualifications to assume it. So they would just go to whoever holds that mortgage currently. But then, a parent gifts the rest of the money
Hmm.
and they move in and start their just keep the same payment that the previous owner had.
That makes more sense.
Pretty cool. Hi, Mary Lou. Hi, Paige. Paige, have you been in one of the mortgage hacks classes yet? I did one with Gina. I don't know if you were on that one or not. I don't know if she can hear me. Not sure. Let's see if. Oh, no worries. Get it, girl. Oh, okay. I thought you were in one. Okay, cool. All right. So for those who don't know me, I am Kayla. I'm with Keller Home Loans. I'm bummed because I like to do these in person, but I'm glad you guys are all joining on Zoom. Sometimes I have a couple of people in the training room with me, but you can find me in the legacy office at least 3 days a week. I bounce around between a couple of our legacy offices, but Canton is my main office. And I'm happy to answer any questions or be a sounding board for any deals that you have going on or second opinions. Um, I also make myself available when you're working. So if that's evenings and weekends, you can reach me anytime. I'm just here as a resource, basically. Um, we have Keller Home Loans has a unique program specifically to Keller Williams agents, and that is our 0+ loan. So I always want to highlight that for anybody who doesn't know about it, but a lot of people do. So 0+ is a program that waives the lender fees. And then if the loan amount is $150,000 or more, we also give them $1,000 toward their other closing costs. So title fees, buying down the rate, whatever that may look like. So it definitely does help. We're very competitive when it comes to rates. But in this market, I think a lot of people are struggling to come up with the cash to get into homes. So it's a great program, and we can layer that with any other down payment assistance programs, things like that, except for the Ohio one. So Ohio also has down payment assistance programs. We are a preferred lender of Ohio Housing Authority, and we can get up to 5% toward down payment, closing costs, things like that. So if you have people that are looking to get in the market but may not have, 3%, 5%, 10% saved up, we have solutions for them. Also, I am equipped to help with credit as well. So we don't send those people out. We don't charge them for credit repair. We have a couple of tools in-house. Once we do a soft pull on their credit, we're able to actually give them a customized game plan to them and then a time frame. And that time frame is very important because I put them on my follow-up system, but I also let you know what their time frame is so that you can keep the touches on them so that they're not working on credit and then going off to Zillow and setting up showings with other realtors. So that's a little bit about what Keller Home Loans does. I was telling Joseph that this probably will take about 30 minutes to go through the playbook, and then you guys will get a copy of the playbook. But I didn't want to kind of just like send it out and let you read through it because I don't think anybody wants has the spare time and is excited to read through mortgage hack. But this is a little bit higher level than just the intro or basics to lending. So outside of your typical conventional FHA, these are some ins and outs that could set you and your buyer apart when you're writing up an offer. There's also some things about buy downs and offering buy downs with listings. So if you represent any sellers, this could be a great way to market a property, maybe in a market that's homes aren't going as fast. I know some realtors were using those buy downs in the winter market on some higher priced properties, and it really did help move them. So I'm going to share my screen because I think Amanda gave me the power. I want to do this one. Okay. This is so much nicer than being in the training room because now I can actually like see. Let's see. But you guys see the Zoom screen right now? Or do you see the mortgage hack screen?
We see the mortgage hack screen.
Okay. Oh, there it is. It's green. It's too big. All right. So I'm going to go over, like I said, you'll have time to read through this. What I want to touch on first is just basically a partnership versus passengership. And what that means is as a lending partner, it takes all of our skills, your skills, my skills, to get these buyers through the process and to the finish line. And a lot of times, lenders will kind of keep everything separate. They don't want to blur the lines but honestly, for the smoothest transactions, I think that open communication is the best. Also, like we're all invested in each other. With Keller Home Loans, I'm actually part of the profit share tree. So I'm bought into your guys' success, and vice versa. So I partner with tons of agents in the office, whether it's setting up a booth at a home and garden show, sponsoring a giveaway that they have going on. I know last night was the SCAR event and we had a basket raffled for SCAR to help raise some funds for representing you guys in legislation too. So, you might have a lender that has their hand out and they want you to send them their business, but we try to look at the whole relationship and make sure that we're growing your business and not just sitting there waiting for you to send us leads. So we look for those opportunities, but if you guys have any opportunities where we can help grow your businesses, especially as you're getting started, let us know. We're happy to help. And if you want to sit down and talk more in depth about any of our programs, like I said, I'm in the office usually about 3 days a week. Just shoot me a text and we'll block off the time. Hey, Megan. Okay. So I was kind of talking to Joseph about how some of these hacks are going to be used in different cycles in the market. So right now with the higher rates, a lot of people are talking about assumable mortgages. When we had 2 and 3% interest rates, no one was talking about assumable mortgages because it wouldn't make any sense to assume a higher rate. So some of these tools you're going to be able to use in different markets to help set yourself apart, set your buyers apart. With this in particular, like you might actually hear some buzzwords through this training. Not so much lately, but some buy downs were a big thing just through the winter months. And even a couple years ago when the rates had just started to go up. everybody was talking about 2-1 buy downs and 3-1 buy downs and things like that. So if you guys have any questions at all, I've got the chat up here. I'm going to keep an eye on it. But please feel free to interrupt. All of my trainings are open forum. So I want to have a conversation. I want to hear your scenarios. And I don't like, for me, I learn better when I have an applicable like scenario. So if you have something, especially on your plate right now, and it triggers a question, don't hold it, just pop in there and I'll be happy to answer. So like I said, a lot of these programs and hacks are going to be contingent on the condition of the market. And we're gonna touch on the 40-year mortgages. I can tell you, I don't think I have any investors right now that offer 40-year, but it is becoming a thing, mainly in those bigger markets, Colorado, California, New York. For the bigger loan amounts, definitely opens up more purchasing power for people when they can spread that payment out over 40 years versus 30. So we'll get into the buy downs right away, which is, I hate that this is the first, but it is a little much. They do give us a really good visual. It'd be really great if all of us had an average purchase price of 500,000, wouldn't it? I mean, maybe somebody does, but it's not me. So, with a 3-1 buy down, a 2-1 buy down, the 3 and the 2 those are going to refer to the first year and the second year and the third year in that loan. Okay. So basically what you're doing is you're getting a seller concession that is used specifically to buy down the rate over time. So you can do a permanent buy down and that can be paid. And Megan will take a couple of $500,000 sales for sure. I mean, that would get you a solid paycheck for the month. So with the permanent buy down, that can be paid by a seller or the buyer. So if they decided they wanted to do upfront interest and get a lower rate, they can do that. Absolutely. I'm not encouraging it in this market because we are in an election year. Although we can't guarantee anything, a lot of the experts are saying that we can expect the rates to come down around September. So in preparation for that, we're kind of advising people to not throw your money at points right now because we'd rather you save that money and do a refinance to get more bang for your buck down the road. Now, if they say, and a lot of people do, I would rather be comfortable in my payment now and not bank on what the future rates are going to do. That's totally understandable. And those are two schools of thought. So if any of your clients want to kind of talk rates, like Joseph said, you don't have to be an expert in the field. Obviously, I want to equip you to know enough to be dangerous, but don't go rogue on me. I'm happy to answer any questions anytime. I'm always reachable.
I have a question.
So, yep.
So if people are saying, I want to hold off until September because I've been told that the mortgage rates are going to go down, the interest rates are going to go down.
Mhm.
What's the minimum for refinance, and what is your suggestion of how we talk through that with a client?
Okay. Very good question. I'm in bold right now, so I'm going to pepper in a little bit of our bold logic here because this was the exact question that came up. It is very tempting to jump in and give them well, when rates come down, prices are going to go up. You can't change the price of the home, but you can change the rate down the road. You definitely want to acknowledge that their concerns are valid first. And then we start to get into well, tell me more about, how much you're paying in rent, because let's all be real, rent is 100% interest. They're not going to see any return on that investment at all. So when a lot of lenders right now are advertising, if you finance with them, then your refinance will be free, and we can absolutely work that into their future refinance. I will tell you, they don't have to hold that loan for any certain amount of payments before they can be eligible to refinance. Lenders are going to encourage that they make 6 payments. That is because we get penalized when we have an early payoff, but it's not required. So a lot of times if I have a client that's worried about rates coming down later on, I just assure them we're not going to waste any money on the buy down now because I'd rather save you more. And there's really no threshold. There is a calculation that we use. It's called a net tangible benefit. So what we do is we'll take a look at what are we trying to do with this loan? Are we going to lower the rate? Are we going to shorten the loan term? Are we going to do cash out and pay off some other debts? So with all of those moving pieces, your net tangible benefit is going to be different for every customer. And we have tools. It's actually called a mortgage coach. We have tools where we can plug all those things in and show them their full picture, because it's not like it's not just a mortgage. You're leveraging an asset for your whole financial picture. And so I came from banking. I am not an order taker. I don't just do mortgages. I give credit advice even when they don't want it. And I will look at that whole picture. And if they have financial advisors, I also encourage them to talk with their financial advisor or get me on a conference call, because I love working together to get to their overall goals. So unfortunately, there is no set answer for that refinance question. I will say most lenders are going to advertise, hey, if you finance with us, we'll get you a free refinance in the next 6 months, or, however long it takes for them to find a net tangible benefit. And then over the next few months, what I'm going to be doing is calling all my past clients to see if there is a interest rate in mind, because during the first refinance boom in 2020, there was a short period where they actually raised the rates a little bit in order to process all that volume, but we knew that they would come back down. So what I did in that time was I called all my past clients and I got their target interest rate. Like, what is the interest rate that you're going to say, hey, Kayla, if you see it hit this, don't even call me, lock it and go. Like, get me that savings. You don't even have to ask. So that could be a good way if you want to make calls to past clients or prospect for new clients. That could be a good way to call around and say, hey, what's your current interest rate? Where would you want to see the rates before you actually jump on a refinance? And we can actually, if they're contemplating getting into the market now, we could forecast what their new mortgage would look like after they've, made a couple payments and the rates drop. I want them to be comfortable in their rate today, but also we can totally show them what that would look like down the road, because we all know that everybody has the same logic right now, and we all know what those prices are going to do when that happens.
I have a question too. Yeah, sorry, because I'm never had a mortgage, so I'm just asking.
Go for
There's
it.
got to be a catch
Yeah.
to the refinancing, because there's no way a bank would just be like, yeah, come so we can pay you less, or you can pay us less money, essentially.
So it's all, if you can think, I just think of it as the cups game. You know how you're like moving all the cups around and it's like the marble that's under the cup and you're trying to find the
Mhm.
marble. All the banks are trying to capture all these loans. So it's not so much that they want to refinance everybody that they already have, but if they don't refinance those people, those loans are going to go somewhere else and refinance.
Oh, so they could essentially go to another bank, get a new loan at the lower rate, and then that bank will pay off the other loan.
Yep. And they'll no longer make the interest on it.
There
Oh,
is fees though that are involved in a refinance.
yeah, that was my main. I feel like there's got to be something.
Yeah. They're going to make money off those fees, but they're also going to the idea is to maintain the volume that we have and then grow our volume, because I know some people have the logic that you have to refinance with the bank that you currently have, and that is not the case. You are a free agent.
Okay.
You can
And
also refinance,
you
you can
guys,
also refinance and um roll those fees into your loan 9 times out of 10. So, when somebody's saying, oh, I can't afford to refinance, or I can't afford to, go do that. There's a lot of programs out there that you can roll things into the loan.
So
What
there's
are the
like,
fees?
so we waive our lender fee. Title, a lot of times if you go back to the same title company, they'll give you a discount on the title work if you just did it with them. And then again, we can roll those fees in, and then we set up a new escrow account. So the escrow account is going to hold your taxes and insurance until those come due. So taxes are due twice a year, insurance is due once a year. Part of their monthly payment is going to go into that separate account so that those funds are there when the bill comes due. The
Okay.
nice thing about refinance and the timelines, and I always push refinance around October, November, because by the time we get done with their loan, say we close early November, they're not going to have to make their November payment. Their first payment's not going to be due until January 1st. So now they get to skip 2 mortgage payments, and they'll get their old escrow account refunded because we've started a new one. So they get to cash flow a little bit with a refinance, even if they're rolling things into their loan. They're still dodging a little bit of interest in that time frame that we're getting the new loan set up to.
Okay.
So it's always a really great value add to your clients. I mean, even if you wanted to put this out in a mailer or a postcard and say, hey, the holidays are right around the corner, rates are low, do a refinance and skip 2 mortgage payments. You have to play those cards right, like exactly right. It has to be in the first like half of the month for that to happen.
Isn't there a lot of rules on advertising that though?
I think for you guys, yeah. I mean, all of ours, and we'll have materials for you that are already FDIC approved and from our legal
Yeah,
side.
I just remember that there was a bunch of like if you say something on a mortgage, you have to provide like interest, down payment, like
Yeah,
4
your
different.
disclosures.
Yeah.
Yeah. So we also have other tools like Total Expert where you can get marketing material co-branded to you and I. We also have a portal called List Reports, which is amazing. So you can get shareables for social media that are set to go, and you can look up refinance things to share out. List Reports is really cool too, because if you have any listings, if you're signed up, when I invite you out and you accept the invitation, you're automatically signed up. So when you have a listing hit the MLS, you're going to get an email with a marketing packet for that property. Single site property, you'll have sign-in sheets, open house flyers, sign writers, like whatever your heart's desire. And that's free to you guys. So yeah, that will cover your butt on the marketing piece and verbiage. And you don't have to be the expert, but people start hitting you up with those questions, just direct them to me. Okay, so we're gonna go back to the 2-1 buy down. So there is absolutely no benefit in the client doing their own 2-1 buy down. A permanent buy down, yes, but for the 2-1 buy down, it's not really beneficial. So this is going to be a case where you're going to get seller concessions, and it's the same cap applies. So you can get 3% on conventional loans from the seller to go toward whatever your buyer wants to put it toward. I know there's a lot of talk around commissions. You can also do closing costs. You can also do buy downs. On FHA, that goes up to 6%. The percentage also goes up on conventional if your buyer is putting a bigger down payment down. So if it's like 10% or more, you can get a little bit more seller concessions out of the seller legally. So in this situation, we have a $500,000 purchase price. They're putting 5% down. They're going to get 3% concessions from the sellers. The market rate on this loan is actually 7%. Now there's not a specific dollar amount for each point that is bought, and a point does not equal a percentage. So in this example, 1 point is actually buying them down a quarter, and that percentage is based on your loan amount. So, I had a situation where it was a weekend and the client was like, you know, my client's and a new nurse. She's going to be making a ton of money over the next few years, but right now she's a little nervous to take on this monthly payment, but she's really in love with this house. How can we get seller concessions to do this buy down? So we put this whole grid together for them, showed them exactly how much they needed to ask for. So in this situation, in the first buy down, in the first year, they're going to buy that rate down to 6.125. Okay. So that saves her 0.75 on the monthly payment. It's going to save her like almost $1,000 or what? I'm not even looking at this, right? Oh, I'm looking at the wrong column. So it's going to lower her monthly payment for the first year because they're going to put all of those seller concessions into an escrow account. And it's the seller's money that's going to make up the difference in interest every month. Okay. So that first, she still has to qualify at the 7%, but now she can lower her monthly payment in the first year with those concessions. Okay. And then we're going to buy down the interest a little bit less on the second year. So her rate will progressively go up until we reach that full 7% in year 3. Okay. This is going to be very useful. And sorry, my dog. No, the school bus goes by every day. You're fine. No, nope, knock it off.
If
In
he's
my house.
barking, we can't hear it.
Yeah, okay, good. Okay, so in our situation, say they do get into a 2-1 buy down and the market turns and the rates go lower, what we can do is we can still refinance them and they're not going to lose that benefit because all the seller concessions that went into that escrow account are now going to go toward their principal. So we're going to lower the loan amount of their principal before we refinance them into a lower rate. So they don't lose the benefit of those seller concessions at all. And they're still going to get a lower interest rate monthly payment.
All
Is
right,
that
I'm sorry if I misunderstood, but why are we holding on to those seller concessions instead of using them immediately?
so? We're going to use them in the form of lowering interest every month.
Instead
So
of
it's
buying it down at the beginning?
correct. Instead of doing a permanent buy down, because the permanent buy down is probably only going to give her like 1/8 of a point. If you use those concessions to do a permanent buy down over the 30 years, she's probably only going to save 0.125% on her whole loan. Okay. So it's really only going to move the needle a little bit on her monthly payment. But if we put those concessions into that separate account, and what happens with interest at the beginning of your mortgage is it's all going to be interest heavy. You're going to have very little going to your principal. So this is going to offset a portion of your monthly payment. So $235 is going to offset every month for her. And that 235 is going to be slowly pulled out of the escrow account. Okay, for the first year. And then it'll save her like $79 in the second year. So
I guess I don't understand, like, why is that lowering, like, how does it sitting in an escrow account lowering her payment? Or is it, I mean, I'm just, I don't know, maybe I'm thinking of it.
Yeah, so what happens between, okay, her market rate, her actual loan interest rate is 7%. But in
Yeah,
the
I
first,
thought this chart's based on a buy down.
it's going to be a 2-1 buy down. So essentially in the first year, she's buying that rate down by 3 points, which is 0.75% in this scenario.
Okay.
Okay. So that's a difference monthly of $235 in interest. So that escrow account is going to be set aside, and every month $235 is going to be pulled from that account to make up her 7% interest, but it's going to alleviate her payment.
Oh, so this is only gonna work, so if it's a
So the
3
loan is
on the
still getting
first year
paid
would
for.
be 3 points, second year would be 2, and then third year would be 1?
So in this situation, the first year they bought it down 3 points, the second year is going to be bought down 1 point, and then the third year would go to the full 7% interest rate.
Okay. or I mean,
This is
it kind
tough.
of makes sense, but like, I just don't understand. Isn't that essentially the same thing as like taking the closing concessions and putting them in your bank account?
I mean, you could do that, but a lot of people don't trust themselves to allocate it to that monthly payment for 24 months. You know, they're going to spend it.
Oh, okay. That, yeah, I guess that's not what I would do, but
I know. Well, when you see a lot of people's finances day in and day out, like that's what most people are going to do. Most
it
people
might
are
be a
going
good
to,
idea to force them to do that. Yeah.
yeah, if they have it, they're going to spend it. So in this case, the bank is structuring it for them. I mean, that's completely valid.
Yeah, I mean, I was thinking, I'm like, you're gonna save the money either way.
That's the point.
I would take the 14,000 and put it in 5%, get 5% at least on it or something.
I know, but some people need that discipline put in place for them. So this is another graph here. And like I said, I mean, you could do a permanent buy down, but again, if they were to say throw $4,000 to buy the rate down, maybe a quarter of a point. And then within 6 months, the rates drop anyways, and they want to refinance because there's even more savings for them to get. They're never going to find a break even point. They're never going to recoup the 4,000 that they threw into it from the beginning. And that's what we want to look at. We want to look at their break even point and realistically, you know, especially for refinance, like if they bought their starter house as a 5-year plan and they're 3 years into their 5-year plan and the break even point on a refinance is like 30 months, it doesn't make sense for them to refinance because they know that they're not going to recoup what they spent on the refinance and savings. So we look at all that. You guys don't have to worry about it. And I think this, yeah, so this is just breaking down. So you guys will have this, but this is breaking down the thresholds for contributions. So it shows you once the buyer hits that 10% down on conventional, then the seller contribution actually can go up. Okay. So there's a little table cheat sheet for you. But I get that question all the time, especially on weekends when people are putting offers together and stuff. What's the max that we can ask for? A 5-1 arm. This is not a buy down. It acts kind of like a buy down, but it is an adjustable rate mortgage. It doesn't mean that the rate can adjust to any random number. You know what it'll adjust to. But essentially this is going to balloon after like 5 to 10 years. And they're going to have to refinance out of it anyway. So some people will request an ARM because they want a lower rate in the first couple of years in hopes of refinancing. Right now, I can tell you that there are still, even if you don't do a buy down, there are still points associated with adjustable rate mortgages. I've had a couple of people request side-by-side comparisons to a conventional fixed rate or the ARM. And when we put those two side by side, it's not even close. With the fees that are associated with those arms, the savings isn't worth it. So a lot more people are just trying to keep their cash as low as possible or put more toward the down payment than fees and buy downs. So I would say if your client brings it up, it's totally valid. I understand what they're trying to accomplish, but there are other ways to accomplish some savings there without taking the risk of an adjustable rate on. 15-year mortgages. We can actually customize any loan term. So we have 10, 15, 20, 30-year programs. But if your client says, I want my loan paid off in 12 years, we can absolutely amortize that for them too. And the reason they would want to do that is, and right now there's not a huge benefit in interest rate. So during the refinance boom, like you might be looking at 3% on a 30-year versus a 2% interest rate on a 15-year. So there's a huge full percentage savings there. The gap has closed a little bit on that, but you can still save over the term hundreds of thousands of dollars when you shorten the term. And essentially, in some cases they've paid for the house 2 and 3 times with the interest rates. So if they're financially disciplined enough, if they're buying low enough under their maximum pre-approved amount, this would be a good option for them. I see a lot more people buying at the tip top of their budget, but if they can qualify with a 15-year payment, then they would have that paid off, and they would over time spend a lot less on that home than originally. So if you have clients that have bought in the last 2 years in a 30-year mortgage, if they do go to refinance in the next 6 to 9 months, this might be a valid option for them. So same scenario, $500,000 house, everybody's averages are going up and everybody's happy. Down payment is 5%. If you look at the 30-year monthly payment, it's really, you're only saving what, $900 a month between the two, which, I mean, that's a lot. But on a smaller loan amount, the disparity wouldn't be so big. So in this case, over the life of the loan, are you guys looking at that total interest over the life of the loan with me? The difference in a 15-year versus a 30-year is insane. And that's over just 1% difference over that term. So when I say you're paying for the house twice, you really are paying for the house twice. So again, a lot of people are not financially set up to be able to do this, but if it can be done, it's a great option. And I had lots and lots of people doing that in 2020 and 2021. Makes me happy. I'm just going to scroll right past this 40-year mortgage. If it becomes relevant in our market, I'll be sure to get more information out to you guys. But if you look at that same interest, total interest over the life of the loan, look at that 30-year versus the 40-year. This is why we're not even going to talk about this. I mean, if you have $1 million property,
But it's
then
cash flow.
yeah. I hope you're doing a lot more with that cash to make you money to offset this cost, this loss. Lock and shop. Again, not a lot of people using this, but if anybody's worried about the rates actually going up while they're shopping, we can do a lock and shop. They're not going to get the market rate for the day. They are going to have to lock in at a little bit higher rate, but we guarantee them that rate. So if rates do go up and we've locked them in, they get 60 days to shop. Well, it's 120 days, but they have to be under contract on the property on day 90. So we offer that a lot. Some places will offer a lock and shop. Usually it's only for 30 days. So if clients are worried about the rates going up, that's one option. Now, I have a second, it's not in these notes, but we have a second feature at Keller Home Loans. If say, and I don't typically float rates, some people will start the loan process and watch to see what rates will do, and they won't lock it in until the end. I want my client to be completely comfortable knowing that they've locked in at the best rate for that day that they've gone under contract, because I don't want the rates going up on them. However, if the rates do move down, and we have a little margin that they have to move down enough by, I can offer a one-time float down for free. What that means is they locked in at 6.99%. Now the market is at 6.75%, and there's enough room there for us to go ahead within 14 days of their closing. If they're clear to close, I will call up your buyer and say, hey, Mr. Smith, I know the rates have gotten a little bit better, and now that you're getting ready to sign on your closing papers, I want to make sure that you can benefit from those savings. So a lot of banks, what they'll do is they'll lock in a rate, and if the rates get better, they just pocket the difference. at closing, and we pass that savings on to the client. So a lot of people are confident in walking in with me because they know that either way they're going to get the best deal based on the market by the time they get to closing. Seller financing, this is really tricky. Obviously it cuts me out of the picture if you need a new loan. But you probably, especially if you're newly licensed, you probably went over land contracts in your classes. Lease to owns. I really hardly ever see anybody carry out the purchase. They usually drop out of these contracts before they actually buy the property or finance it into their names themselves. But these are options if you find a willing seller. Some scenarios, and Joseph, I'm going to get ahead of you on the question because in my mind, I'm going, why would a seller want to be the bank for their buyer? Why wouldn't they want to collect on the property and move on with their lives? A lot of the times, if the seller is going to be taxed or penalized or, get hit with capital gains, they would much rather recoup their return on the property over time than get hit in that aspect. So if you have a seller that you're representing and they're like, yeah, I mean, I'm okay with land contract because that'll help my books, that could be an interesting scenario where seller financing can work. And it touches on those assumable mortgages. Joseph and I were talking before a lot of you guys joined, and one of the things about the assumable mortgages is they do have to go through that current bank who holds the mortgage. They do still have to get qualified. They just pick up where the seller left off with the balance and the monthly payment. However, they're going to have to make up the gap one way or another. And they can't use a home equity line because they don't own the equity yet. So it's going to be, a second mortgage, and that mortgager is going to have to be okay being the second lien, which is hard to do. Or like I kind of laid out a scenario for Joseph is like, if you have a 25-year-old whose parent is eager to help them get into a home and they're willing to gift them a lump sum of cash, that cash could make up the difference in the gap between the purchase price and the loan balance. And then they can assume, say the house was purchased in 2020 and they've got a 2.75% on their interest rate, that new buyer gets that 2.75%.
This might be too in-depth of a question since you're not an accountant, but would that, I know you're talking about capital gains, but that would be generally under 2 years of owning a home. But do you know how it works with people that are getting Social Security checks? If they collect a huge or surplus on their home, I guess whatever they made on their home over however long they owned it, would they
If it
get hit with,
disqualifies them.
yeah, would they get hit with capital gains tax there? Would it disqualify them, or because that's something I would see like seller financing because rental income's not in doesn't isn't
Count against them.
considered like or I don't know,
Yeah,
it doesn't violate the Social Security, whatever you want to call it.
yeah. Yes. And in the same aspect, we do reverse mortgages. And if we were to give somebody a payout on a reverse mortgage, they would not have to claim that in their Social Security, Medicare, Medicaid.
Okay, so and that it wouldn't matter. So the seller financing's biggest when people like are in and out of a home essentially.
Mhm. Yeah. And I literally just had I have a client under contract right now to close on the 21st, and they were trying to close on the 15th, and I called the listing agent and I was like, you understand if you wait 6 days, they're going to avoid the capital gains on this. And they're like, oh, we didn't look at those dates. So they look like a
Yeah.
hero.
20%. You
Yeah.
saved them tens of thousands of dollars.
Yeah. So, I mean, these are the little things like these mortgage hacks and those tips and tricks. Like not the average agent is going to know about those things, but you could be the hero for your client, and that's going to create longevity, loyalty, repeat business, referral business, you name it. Trust and deeds, wraparound mortgages. I used to work with a lot of trust when I was in the bank, and I was very well versed in this. However, it's a specific scenario. So I'm gonna glaze over this because I am a little tight on time, but if you are dealing with a seller where the property's in a trust and they have questions about a wraparound mortgage, and again, this is going to be kind of like a seller financing, let's get together on a one-to-one basis because this is very, very high level, very involved, and definitely want to consult with their attorney too. Homebuyer assistance programs, a lot of lenders try to steer clear of this because it just requires a lot more documentation. You have to watch income limits, and you have to know the programs well. I think it's a great tool to have because it creates buyers for you. Where they thought there wasn't a way, now there's a way to have the funds to buy a home and get out of the cycle of rent. So I'm a big advocate for this. We are a preferred lender for Ohio's down payment assistance program, which also includes a first responders program, teachers program, grants for grads. So anybody that's graduated in the last 24 months, they have conventional FHA programs. So I'm pretty well versed in the Ohio down payment assistance. Locally, Massillon and Canton both have their own programs, which are a little bit nicer because they don't put a second lien on the property. Additionally, I don't know if this is the case for Canton, but Massillon will send their own home inspector out to make sure that they're okay with the property. And if there are any repairs that they require, Massillon will also grant them an extra $5,000 to do, have the repairs professionally done. So if you have any buyers, they do have to be under an income limit, and it's a household income limit. Our newest program is a 1% down program. We're doing a match of a 2% assistance, which is forgiven. There's no second lien on it. So essentially they are getting the 3%, the full 3% down on conventional loans, but they're only having to come up with 1% of it. So, more on those programs. If you have somebody that is wanting to look into it, I can get them qualified. For Ohio, I can actually reserve the funds for them. They don't have to apply separately. They just have to do the education and home counseling when Ohio reaches out to them, but I reserve the funds. For Canton and Massillon, they do have to apply personally and individually separate from the loan that I give them. Early payoffs. Most mortgages these days have 0 early payoff penalty. Back in the day, the bubble burst, this was a big sticking point because people were not refinancing into lower rates because they were afraid of the early payoff penalties. Now they're not cornered into their higher rates because there's no early payoff penalties. They can refinance, they can make extra payments, they can put lump sums toward the principal, and they don't have any worries about getting hit with any penalties because of it. I always tell people, especially when I was in banking, that home equity lines of credit essentially is leveraging the value that you have in your asset. And you can borrow against it, pay it off at a lower interest rate over the course of 10 years. It's good to advise your clients to get home equity lines. I think they're once they've owned the property for 6 months, they're eligible to get that financing. Some banks don't make them wait, but most banks will make them wait a 6-month period before they can get it. You always want to get a home equity line when you don't need it. It's a great safety net, especially if it just sits there unused. But if you get into a pinch, a lot of times it's going to take too long, or maybe you don't qualify, but it's there. If you get it done, it's there. It's good for 10 years. You don't have to think about it. I've had people that have written checks for cars off their home equity line. You know what their interest rate is, and they're good to go. Removing private mortgage insurance on FHA loans. It doesn't matter what they put down, that private mortgage insurance is going to be there for the life of the loan. That's why conventional is appealing, because they can actually get rid of that. They can do one of two things. They can put build 20% equity in the home, and then they can call to get it removed. If the values go up, even if they haven't paid down the balance, but the values do go up and the equity is there, they can always request to get it removed that way too. Getting rid of the escrow account, they don't have to buy into the escrow at purchase if they have 20% down. If they don't have 20% down, it's a huge risk factor. So we do require that we put the taxes and insurance into a separate account until there's a little bit more value built up in the home. And that's just a risk factor. Getting rid of, house hacking. This is a huge concept in KW, and I love the wealth building and the growth focus and education through KW. House hacking would be if you have a client that wants to build an investment portfolio, but they need to do it with as little money out of pocket as possible. The best way to do that is for them to live in the property for a set period of time. Usually it's 12 months. But with house hacking, they get into the property, they're there for 12 months, and then they rent out the property and buy their next one. And like I said, what that's doing essentially is getting them a better rate because it's owner occupied, and it's limiting the amount of cash that they have to bring for that investment.
That would be an FHA. You're talking like an FHA loan there, aren't you?
Yeah, FHA only requires 3.5% down on a
And you
multifamily unit.
get to live there for a year.
Yep, 12 months. And I have heard them like checking, like they mail a voucher to the property and you have to sign the affidavit that yes, you still live there. Making payments with a cashback credit card. I'm pretty sure we allow payments with a credit card, but some clients offset some of their interest with those cashback earn rewards. So pretty much just went over all of these things, but there's some more visuals for you. Does anybody have any questions? Make sure I didn't miss anything. Key lock, getting rid of escrow, live in the property, house hacking.
I have a different question. How hard is it in what you've seen to qualify for an FHA? Let's just say like under 250 or under 300.
FHA is the easiest product to qualify for. It's very commonly known as a first-time homebuyer program. It's not necessarily the first-time homebuyer program. You can use FHA without being a first-time homebuyer. FHA is a lot more lenient on credit requirements, and they go a lot higher on debt to income ratios. So
would it be a lot to do with would it have anything to do with what the property would bring in rental?
if they needed to offset, if their ratios were too high to qualify on their own, then we would look at what the other side was rented at.
Yeah,
And
I guess
then,
I'm saying for myself is I don't have a lot of reported income over the last few years to the like on my tax returns, but let's just say like a property was bringing in more income than the monthly payment would be. Would I have any chance of qualifying?
So it would be a combination of whatever you claim on paper, what we can use as qualified income, and then we would take 75% of the signed lease amount and add that to offset your monthly payment. So yeah, it would factor in, but
All right.
without having like rent claimed on your tax returns for history, whatever. If you're just buying into this property, you can use 75% of the rental income on that signed lease on your loan application.
Okay.
Okay.
Might have to talk to you in 7 months, but we'll see.
Well, and I like to talk to people, like if you have an extension on taxes, let's talk. You can go back on taxes up to 2 years and amend them. So I like to talk to people at the beginning of the year before they filed, so I can look at their profit and loss statement. Because there are some ways that we can take the deduction, but then add it back into your bottom line when we're calculating income. So because everybody on here is getting a 1099. If you want to find out ways to qualify your income better on tax returns and still get the tax deductions, let's talk. Okay. I'm so happy you guys joined today. Thank you for taking the time. And I'm going to, can you put all of your email addresses into the chat? I will go ahead and get this mortgage hacks book out to everybody so you can refer to it, but also you'll have all my contact information, and feel free to reach out with any questions.
Is this mortgage check, is that something we can like print this out and share it with the client?
Sure. Yeah, it might be a little too in-depth for them to read through. But if they just want to have a conversation around their specific scenario, I'm happy to do that too.
Okay.
All right.
Thank you.
Thank you guys. Wait, who was that? Was that
This is
Paige?
Allison.
Allison. Thanks, Allison.
Yes, thank you.
Yeah, absolutely. Go
right.
ahead and drop your guys' emails there and I'll get this pack book out to you.
Thanks, Kayla. Sorry for all the questions.
No, Joseph, I'm glad we got to talk. And again, I like your questions, so come bug me anytime.
Perfect.
All right. See you guys. Have a good afternoon.
Thanks, you too.
What are you doing? Getting a snack?